Well, we've seen a pretty strong rally in natural gas over the past month. Keep in mind, though, this is coming off of a pretty low base. Nat gas prices plunging over the last couple of years. Our next guest wouldn't chase the rally here. Max Layton is Global Head of Commodity Research at Citi and joins us now with his perspective. Max, a lot of, particularly our natural gas stocks here, have been waiting for nat gas to come out of its hibernation. You think that this is a little bit of a false dawn here?
Actually, prices have, really just run through our $2.50 target, and we're a bit above that level. So we're at levels now where we're past the shut-in. We're well past the shut-in economics. So we're actually in restart territory, and that's the main reason why we're saying not chase this rally.
How much does weather affect things? Oh, I mean, obviously it does affect things, but if we get this really hot summer, could that change your thesis, or are you really focused on the supply side of things?
I mean, it certainly could, right? It's always a combination of both. I think, we're really focused on the production side of things in the very short run, in terms of the next move. And, production's come off 7 to 8 billion cubic feet a day since the February run rates in the, across the US, L48, in terms of dry natural gas production. And, so there's a lot of room for that to kind of rebound and bounce back over the next few months.
One of the other commodities that we track closely, and I know you do as well, has been copper. After hitting record highs, we're seeing a little bit of a cool down. What's your outlook? What was the move to $5 faster than you thought?
Look, I mean, to be honest, yes, it was faster than we thought, say, 6 months ago. But I think, it was one of those ones, if you go back 6 months, where you didn't know, but it seemed very high likelihood that at some point over the following 18 months, it was going to have a strong run. And, you didn't really know on the timing, but, at some point when people got a little bit less scared about the cyclical downside to global growth, that there was going to be a big run. And that's precisely what happened. So, yeah, I think, it's happened sooner than I would have thought. But, thankfully, we and, many of our clients, I think, caught some or a good chunk of the rally. And, now, maybe I'll wait for the next question.
Well, I think you know what it is. What happens next?
What happens next? So, I mean, there's been a kind of a pretty wild amount of copper futures buying and options buying, of which I think the majority has been computers or machines or, otherwise known as CTAs. That portion of the community, they don't have a long-term copper bull view, right? They don't believe in the energy transition demand or the lack of supply growth or the, persistent deficits that many of us see over the coming years. So I think that, there may be in the vicinity of $15 billion plus of machine money that's in copper now that I think will take some time to kind of recycle itself into consumer hedges, who will, I think happily buy off those machines over the next, say, 3 to 6 months at lower prices. And the other part of it is, a lot of the commodity hedge fund community, I think, are looking to buy on dips over the next 3 to 6 months. So, we stabilize here, consolidate here, plus or minus $500 for the next 3 to 6 months. And then we have a big, strong move towards the end of the year and into next year up to 12,000.
So short term, maybe some consolidation, long term, bullish, which I guess, I mean, we've seen so much M&A, at least attempted M&A. We don't know if they're going to be able to buy those companies. But underpinning that, I think, is the assumption that where we are with copper prices, I mean, at least that's on solid ground, because some of these companies are paying some pretty hefty premiums.
Yeah, I mean, one of the amazing things about this rally in the commodity was that the equities, according to my equities colleagues, Ephraim Ravi, Alex Hacking on the Citi team, who they look at the pure play copper equities, these things were pricing in between $10,500 and $12,500 copper, well above let's say $5 plus copper into perpetuity, right, forever. And they were doing that 3 to 6 months ago when copper was trading $8,500. So, one way you could view it is all that's really happened is the commodity investors have caught up to the equity investors in paying for the long-term bull story.
Well, and I contrast that, and I know you're not the equity analyst on this, I contrast that with gold a while back, which was actually underperforming the metal. Now that we've seen gold kind of hang on to its gains, you've seen a little bit of a catch-up trade. But I guess maybe this is definitely a sector when it comes to M&A that have been burned in trying to do deals, assuming that the price is going to stay elevated.
Sure. And look, overall, we're pretty bullish on gold over the next 6 to 12 months. Obviously the big risk is something happens on the China gold import quota side to the downside. But, assuming that the China retail community is allowed and China central bank is allowed to keep piling up the gold, that kind of represents a really strong base for gold together, with the broader global central bank buying. That really means that as real rates drop and you get stronger ETF demand over the next 12 months, we think we're certainly on a path in our view to $3,000 over the next 12 months.
All right.